So in this workshop series, I'm trying to help especially entrepreneurs that are getting investment or raising venture capital investment to better understand how investors value startup companies and help entrepreneurs to do their own valuation. So benefit of understanding how investors do the valuation is that you can then, if you're an entrepreneur, you can then respond to their valuation, negotiate the valuation through having created your own valuation using similar approaches. So what we did in the last class, quickly recap, we focused on, we looked at a quick overview of the different valuation methods, which we're going to cover 2 of those in more detail today. We looked at the foundation of our forecast model, which is our revenue projections. And we learned how to do revenue projections using what I call top-down and bottom-up revenue forecasts. So our top-down forecast is a estimate of the potential demand for our product derived from mostly secondary market research, and combining that with our bottom-up revenue forecast, where we do a second independent revenue forecast using our understanding of our own business model, our potential customers, and our product. And we use the iterative process to arrive at the same valuation arrive at the same revenue forecast using both the top-down and bottom-up method. And we iterate by adjusting our assumptions in each of the methods until we get a convergent or ideally identical result. So we'll have a single revenue forecast. Once we have a single revenue forecast, we can use that as the foundation of our valuation model, because our valuation model always begins with the revenue forecast. Now, that's been done. And step 2, so we need to now project our costs. So we did a revenue projection in the last class. In this class, we're going to look at doing a cost projection, and then we're going to look at how can we put those 2 together to get a valuation. These are these are the 3 financial statements that our forecast model will generate. So when we do this type of financial forecast, it creates what are called pro forma financial statements. And these are the 3 fundamental financial statements that companies use to explain and describe their financial position, and that investors use to analyze the health and the valuation of companies. So we can't, when we're thinking about the value of our startup today, we're always looking at what value is driven by the future results of the startup. We don't, especially for startup companies, and for all companies really, but even more obviously for startup companies, the value of the company to an investor is not the value of the business today, because we're not investing just for today. We're investing for the future. And the reason that's so even more important with startups is the value of the startup today, it's much less than it's going to be in the future. So what we're concerned about is not, for example, how much revenue does the startup have today, although that's one thing we want to know. But what we really want to know is how much revenue will the startup have 5 years from now? So, and we also want to know all the other details of as much as possible, startup's financial position 5 years from now. Now, this is not what it's really going to look like, because nobody knows, it's in the future. But we want to know is, what might it look like if it's successful? So we create this these forward-looking or pro forma financial statements, which simulate what would the financial statements of this company look like if we were reviewing them 5 years from now. So if we were looking at, for example, the company's last 5 years of financial performance in 2026, what would their financial statements look like? And that's what our model is going to create. It's going to create 3 statements: balance sheet. So balance sheet shows the sources and uses of the company's funds. On one side of the balance sheet, you have assets, which are things the company own. On the other side of the balance sheet, you have liabilities and equities, which are the financial obligations that the company has to debt holders and equity holders. So balance sheets just show where did the money come from and where did we put the money to use. Income statement shows after we forecast our revenue, so that we forecasted revenue in class 1, but revenue doesn't go to shareholders because revenue is the sales that we had in the company. Before we could theoretically distribute any money to shareholders, we would need to convert that revenue into income by subtracting out all the expenses that we incurred in generating that revenue. And then cash flow statement shows us the cash position in the company. So how much cash did the company have at the beginning of each period that we're modeling, and then how much cash did it have at the end? And then we can see the change in cash in any given period. Now, when you look at the financial model, the Excel model, you're going to see it looks just like these. The output is basically these 3 financial statements. And specifically, the first 2 are a lot of emphasis in the model. Entrepreneurs, there were some questions from entrepreneurs that don't have a lot of accounting background and feel a little lost looking at the financial statements. And I can heavily sympathize with this. When I first looked at financial statements before I studied any accounting, it's very difficult to understand. So I think that you don't need to be an accountant or have an accounting degree to understand what's happening in a company financial statement. And I would strongly advise, if you're an entrepreneur, like a senior management team member of a startup company, you should take a little time to familiarize yourself with at least the most important parts of the financial statements, because it's going to be very difficult to understand or present or negotiate about the financial possibilities or financial health of your company without being able to at least at a high level understand these financial statements. So you don't have to become an expert, but it's a really good idea to educate yourself at least the basics of understanding financial statements, which it's beyond the scope of our course, but there's lots of resources out there to help you do that. So looking at your revenue model. Now, there were some questions in the last class. People asked about where do we get the inputs to put into the model. So, for example, the bottom-up revenue forecast. So in order to get the bottom-up revenue forecast, we need to develop a revenue model. So every startup needs a revenue model, which is how are we going to make money? And this slide shows several different types of revenue streams, revenue models, and pricing models. And the revenue bottom-up revenue model, which is going to drive our financial model, includes each of these. So we have the revenue streams. Each revenue stream has a revenue model, and each revenue model has a pricing model attached. So we have to think about 3 things, at least 3 things for our revenue. How are we going to, what are going to be our streams of revenue, meaning where our revenue going to come from, and what revenue model will we use in each of those streams, and how are we going to price the offerings within those revenue models. And if you haven't carefully thought through this, I would definitely recommend you spend as much time as you need on your revenue model, because revenue model, it's offers a tremendous scope for innovation, and it can affect the value of your company, as much or more than your product. If you think about some of the most successful startups in the world in the last 5 to 10 years, their success has been basically driven by their revenue model, innovative revenue models, rather than just product innovation, or in some cases, mainly revenue model innovation. So the traditional method of setting your price for company product is under heavy scrutiny by startup entrepreneurs who are looking at many different pricing options. And because we now have many different ways to sell our products, and especially when we're selling digital products rather than physical products, but even in some cases when we sell physical products, we can extract tremendous value from the right pricing strategy. So we don't have enough time in this course to go through pricing strategy in detail, but I would, if those of you that are working on this, I would recommend finding out a lot more about current thinking in startup pricing strategies. We don't price products based on just looking at our cost and then adding a margin on top of that. We don't price products based on looking at what competitors' prices are and trying to price relative to that. We now try to focus on optimal pricing strategies so that we price our products according to the value that they provide for customers. And hopefully we have segmented pricing so that we can vary our pricing strategy based on the customer segment that we're selling to, so that we provide an optimal price for every customer in our business model. So key revenue model issues, very important as we build the financial model. And cost drivers. So we need to get to the bottom line of our financial statements in this class, and which is our net income, and then we want to get to our cash flows below that. So in order to go from revenue to net income and cash flow, we need to model our expenses. We have typically in our model fixed expenses, variable expense, semi-variable, recurring expense, non-recurring expenses. And in a lot of startups, our key cost structures are payroll, so how much we're paying people, inventory if we have physical products, marketing and advertising, and customer acquisition costs. So these are typically the major components of our cost model, and our Excel has several sheets devoted to helping you estimate these costs. Now, one thing I have observed is entrepreneurs are usually much more comfortable estimating their costs than their revenue, and therefore they spend a lot more time on the cost estimate, which it's okay. It's good to get accurate, reasonable cost estimates, but make sure you don't spend all of your time in the model on your cost estimates and neglect your revenue estimates, because we need both together. Interestingly, the major costs that I find entrepreneurs tend to neglect or underestimate in their in developing the cost structure in their model is the customer acquisition cost. And this is something that every investor is going to ask you about, and if you are not able to answer this question effectively, it's going to put a big crimp in your investor pitch. So make sure that you have calculated your customer acquisition costs, and that you're able to explain and defend the customer acquisition costs that you have presented in your model. So how do you do that? How do we calculate our customer acquisition costs? The big picture is we estimate the cost. We can think about this as a sales funnel. So we have a funnel that's very wide at the top and narrower, much narrower at the bottom. Wide at the top is all the customers that we reach out to. So we reach out to customers and hopefully reaching out to a very wide group of potential customers. Of the customers that we reach out to, some of those customers will be not interested, some will be interested. So the customers that are interested, then they become leads, and then we can think about, of the customers that we reach, what percentage become leads. And then we will estimate of the leads, how many will go to convert into a paying customer, for example. So this is a pretty simple funnel. We have reach, and then leads, and then conversion to paying customers, and we have a percentage at the second two steps. And what's our total cost? Our total cost is the cost of all those customers we reach, the cost of converting some of those into leads, and the cost of converting some of the leads into paying customers. That will be our customer acquisition cost. And so we have to remember to factor in all the total costs, the total cost of the customers that we reach. And I see another reason that entrepreneurs tend to underestimate their customer acquisition costs is they'll say, well, actually, the founders are currently acquiring all the customers and we're not getting paid or we're getting paid very little. So our customer acquisition cost is very low. And this is true for now, but that's not what we're trying to understand with the customer acquisition cost calculation. We're not trying to calculate, how much does it cost today using unpaid founders to reach customers, because that's not sustainable. Obviously, in the long run, people other than the founders are going to have to acquire customers, and those people are going to have to get paid. So we want to think about not just our current customer acquisition costs, but our estimated customer acquisition costs. And once we do that, we can also estimate our customer lifetime value. So meaning for each customer that we acquire, how much do we earn from that customer over the lifetime of the customer relationship, meaning before that customer moves on. So that's called CAC versus CLV, customer acquisition cost versus customer lifetime value. The approach that we just took there is called unit economics, and this is something that a lot of investors focus on. Our model also enables you to calculate this, but you can see from my description, you're going to have to make assumptions for each input into the model. And there were quite a few questions from the last class, some questions about how do we derive these assumptions. So there's no single answer for that. It depends on your business, your understanding of your market, and you're going to have to, in a general approach, you're going to have to start with information that you know, and then you're going to have to make some assumptions about the information that you know, and then you're going to treat the second piece of information as something that you know. So, for example, maybe you know that the cost of reaching somebody with a Facebook ad in your target market. So that would be first step in component of your customer acquisition cost. Maybe you now have to make some assumption about what percentage of the people that we reach, for example, on Facebook are going to actually click. And you might be able to you should be able to get some real information about that if you're paying attention to your social media usage data, so you can get some click-through rates. And then you can look at, of the people that click through, how many convert into paying. Now, that might be pretty easy to do, for example, in social media, but you might not be able to do it for other media, like, and maybe your main outreach is not in social media, but at least you have some baseline information that you know, and then you can make some assumptions about how that would translate into other forms of customer acquisition that you're using. So you are going to have to, there's no way around that you're going to have to deal with a lot of uncertainty in creating your financial model, which it's okay. Don't worry about that. I meet some entrepreneurs, and especially entrepreneurs coming from the engineering side or the sciences, where they're used to a high degree of rigor in everything that they do. In financial forecasting, there's some rigor in the financial models that we use and in the formulas in those models, but there also needs to be a fair bit of creativity because we're doing something which is impossible to do rigorously, which is try to project what's going to happen in the future. And because there's no strict formulas for that, we're going to have to use some creativity. And when we get done with our revenue and cost models, it should look something like this. We will have a revenue model. This is a graphical visualization of what our revenue and cost models are going to look like together. And these will, this can form as a framework for the data that you input into the Excel model. Okay, so now we have input our revenue, we've input our costs, we get our net income from our financial model, and we're able to do our financial forecast. Now, where do we go with valuation? So I'm going to introduce a little more detail now about two very important valuation approaches that we're going to explore tonight. The first one is called comparables valuation. And the way that comparables valuation works is assume that we have a company with a known valuation. So we have a company with a known valuation, or more specifically, we have a basket of companies with known valuation. But let's talk about simple case. We have a company with a known valuation. Now imagine we have a second company that was identical to that first company in all ways. So then we could assume that the value of the second company was the same as value of the first. The first company has a known valuation. We have a second company that is identical in every way to that first company, and therefore it should have the exact same valuation. Now, of course, the trick is the second company in real life will never be identical to the first company. But if we still have a first company with a known valuation, and now we have a second company that is comparable to the first company. So it's not identical to the first company, but it is comparable to the first company. And this gives us a valuation method called comparables method, where we can adjust the valuation of the second company for its differences to the first company. It's not identical, but it's comparable. And therefore we can make adjustments to the valuation of the second company to arrive at a comparable valuation. I'll give a simple example how that might work. Let's say the two companies are identical except in the amount of revenue that they have. So the first company has revenue of 10 million, and the value of that company is 50 million. So if the first company has revenue of 10 million and is valued at 50 million, let's say the second company is identical to the first company in every way except it has revenue of 5 million. Therefore, the second company we can estimate should be valued at 25 million. Because why? Because these two companies are the same in all ways except for the amount of revenue that they have. The first company has 10 million, it's valued at 50, which is 5 times. So if we multiply its revenue of 10 by 5, then we get 50 million for its valuation. If the second company is comparable to that company in all ways except for revenue, and it has half the revenue, so it has 5 million, we can then multiply the second company's revenue by 5 to get valuation of 25 million. So that's basically how comparable valuation works. We take companies with known valuations, and then we take our target company, which we're trying to value, and we look at how is that company different from the benchmark company, and then we can make adjustments to arrive at a valuation for the target company. Now, that's the concept. Now, it becomes very difficult, much more difficult in practice. And why is that? It's because no two companies are going to be anywhere near as identical as I was, or comparable as I was suggesting in the example I just gave. Companies that have, for example, very different revenue, there's going to be a lot of other things that are very different about those two companies. So we're going to need to make a lot of adjustments. And what are the most relevant features, most relevant aspects of the company to adjust the valuation based on is also not going to be obvious. And for startups, it's going to be a lot more difficult than it is to value publicly traded companies using comparables, because why? One is startups are typically even less comparable than publicly traded companies to large basket of other companies. Example, let's say I'm running I've started a med tech startup in Thailand. So which is a better comparable base for me? Is it other startups in Thailand? Let's say there aren't that many medtech startups in Thailand, but which is the right comparable base for me? Is it other Thai startups, or is it medtech startups in the US? So am I more comparable by product category or by geography? That's just the beginning of how hard it is to determine what is a clear comparable for my company. The second problem in using comparables is the comparables method. When we really try to employ it, we usually use financial ratios. So we look at not just revenue, but we look at other critical financial ratios that the company has to determine how the target company differs from our universe of comparable companies. And for startup companies, it's going to be often very difficult to find that data, because both we might have the data for our company, but we're not going to have data for a lot of companies in the market. When we value publicly traded companies by looking at comparable relationship to their financial ratios, it's relatively easy because they all publish their financial results, and we can get tons of data to look at. For startup companies, the vast majority of startup transactions happen in private, and the company financials may or may not be available. So it's very difficult to find the right comparables, and it's very difficult to find the data that we need to do the comparable valuations. But this doesn't mean we have to give up on comparables method, because I like to use a variation of the comparables method to help us value our startups, which I call comparable by stage. Comparable by stage means we'll just value the startup based on its stage of development. So if the startup is seed stage, for example, we'll compare it to all other seed stage companies in its geographical market. So for example, it's a seed stage company in Thailand, and therefore its comparable is other seed stage companies in Thailand. And this gives us, this cuts through a lot of problems with the comparables method. And it also, I think, gives us a much more effective means of using comparable valuation. Because why? Because stage of development and the market that the company is in, I think, are the two most important factors in valuing startup companies. And it is it helps us to reduce the problem of insufficient data, because although we don't have necessarily good data on individual startups, but we do have very good market data on average valuations and the range of valuations of startup companies by stage in different markets. So, for example, the vast majority of seed stage companies in Thailand are valued somewhere between 1 and 5 million US. There's some outliers, which are a little less or a little more, and there's a few freakish outliers, but that's a pretty solid range of valuation for seed stage companies in Thailand. Of course, it's a big range because 1 to 5 is like 500%, but it's very useful because when we employ our next two methods, so we're going to use comparables valuation not as the primary method, but we'll use comparables valuation as a what I call reality check on our other methods. So when we move to our DCF method and when we move to our VC method, then we can check the results of those two by comparing them to our comparables by stage valuation. So what does that mean? If my discounted cash flow valuation and my VC method valuation are giving me a valuation for this company which is way outside comparable by stage valuation, then something is probably wrong with the second and third method. Because why? Comparable by stage comes from the market, and ultimately all valuations come from the market. If a calculation method, if a modeling method like DCF or VC method is giving me a result that's inconsistent with what the market is telling me happens in real life, then something is wrong with my calculation. Now, big problems that I see with entrepreneurs that use comparables method. They use the comparables method, but they misunderstand how it's supposed to work. Comparables method works because it compares one company to a large universe of companies. It's basically saying we have a basket of companies with known valuation that are comparable to this company, and we're going to use that to value our company. So I do see a fair number of entrepreneurs come in with a comparables valuation where they have compared only to one company, and the company that they compared to is a freakishly outlying company and always freakishly outlying on the upside. So it's a company that's way overvalued for one reason or another, and the entrepreneur will say, this is the comparable for my company, and that's why I should get the same ridiculous valuation. So you can't do comparables that way and hope that your comparable valuation will then be taken seriously. If you want to use comparables, you have to compare to average valuations or at least a basket of comparable companies. Because if you just compare to one company, then it's just as rigorous to compare to the lowest possible valuation as to the highest possible valuation. So there's no reason to pick one of those or the other, except you're trying to get higher or lower valuation. So you wouldn't want the investor to say, an investor in that situation could very reasonably come back and say, okay, I have a different comparable. You pick one company, I pick one company. They're the lowest company in the range, and you should have that valuation. Neither of those make sense. You should have a valuation of reasonable basket of companies comparable to yours. Okay, and now the star of our show tonight, so the star of our valuation class 2 is the discounted cash flow valuation model. So this is typically called DCF Valuation Model. And the reason I call it the star of our valuation second lesson is because discounted cash flow valuation is the most widely used and arguably the gold standard of valuation for companies in financial services industry. So if you look at any equity analyst valuing publicly traded companies, they will use discounted cash flow valuation as the standard method of valuing those companies. So there is some debate whether discounted cash flow valuation makes sense to apply to startup companies or not. And I understand the terms of that debate, and I definitely see that there are some I agree that there are some issues in using discounted cash flow valuation for startup companies, but I don't think they flow from startup companies. I think the difficulty that we have in applying discounted cash flow valuation to startups is basic to the concept of discounted cash flow. So most of the arguments that people have about why we shouldn't apply discounted cash flow valuation to startup could be equally well applied to why we shouldn't use discounted cash flow for any company. But the most common argument you're going to hear is when we discount cash flows, we're discounting future cash flows, and future cash flows for startups are highly uncertain, and therefore the results that we get from discounted cash flow valuation don't make sense because they're discounting future cash flows that are highly uncertain. And I agree that discounted cash flow values highly uncertain future cash flows, but so does every discounted cash flow valuation. All future cash flows are highly uncertain, and startup cash flows may or may not be more highly uncertain than other company cash flows. And even if they are, we can account for the higher degree of uncertainty in startup future cash flows by adjusting the discount rate. And that's what we're going to do in our financial model. So for those that haven't encountered discounted cash flow valuation before, I'm going to just quickly summarize now. The way that discounted cash flow valuation works is we assume that the value of a company to its shareholders is equal to the cash flows or free cash flows, which are basically the amount of cash that the company, if they wanted to, could distribute to shareholders, for example, every year. So free cash flow means cash flow that would be free to distribute to shareholders each year. So you can imagine that we simplify the whole financial model of your startup into like investment security that is going to pay to its shareholders a certain cash payment every year for actually forever. So because we don't know when your startup is going to finish, and we assume for a discounted cash flow model that your startup will, the company will persist indefinitely, and every year it's going to pay its shareholders the free cash flow that it has available. And how do we get that free cash flow number? We get that from our revenue forecast minus expenses and then adjusted for some non-cash items in our income statement. And we can see from that calculation, how much cash would this startup be able to distribute to shareholders every year? And that's the cash flow part of discounted cash flow. The discount part means what? It means money that you receive in the future is worth less than money you receive today. Because why? Because of something called time value of money. So time value of money means that as time passes, money that you have now is worth more in the future because you can invest it. You could put it in a most simple example, you can put it into the bank and generate interest. So if money that you have today will be worth more in the future, that means money that you have to wait to get in the future is worth less than money that you have today. And therefore, when we receive a payment in the future, we have to discount the value of that payment versus if we receive the money today. Because in this discounted cash flow valuation approach, we're trying to value the company today based on cash we're going to receive in the future. So as we do that, the further into the future we receive cash, the less it's worth today. So we can't just add up all the future cash flows to get the current value of the company. What we do is we add up all the cash flows, but then we discount those cash flows back to the present value. And discount rate, it's like an interest rate in reverse. Instead of growing money today, growing the value of money invested today, it reduces the value of money received in the future. So that's called a discount rate. So if you think about the way this discounted cash flow valuation works, first we project revenue, we project expenses, we subtract the expenses from the revenue, what's left over we make a few more adjustments to, and then we have our future cash flows. Then we discount those cash flows back to today. And if you think through how that works, there are basically two things that determine the value of our company when we do discounted cash flow valuation. One is the forecasted revenue, and assume the expenses are relatively the same. So what determines the value of the company is how much revenue we forecast and how much we discount it. The less we discount it, the more the company is going to be worth given the same revenue and cash flow forecast. The less we discount it, the more the company is going to be worth. The more we discount it, the less the company is going to be worth. So the two things we need to focus on in doing discounted cash flow valuation are the revenue forecast and the discount rate, because by adjusting either one of those, we can arrive at pretty much any valuation that we can imagine for the company. So let's go take a look at how this works in the model. So I pretty much already talked about this. Okay, so I'm going to bring up our model. If you haven't had a chance to, or if you're not able to download our model yet, you can download the model that I'm going to use for the example on our on this course companion website. So we have a free online course that includes all the PowerPoint slides that I'm using here, the financial model that I'm going to demonstrate now, plus the course assignments, the first one of which was due today, and some people actually completed, which we'll review in a minute. But if you haven't had a chance to download the model, please go ahead, because a lot of what I'm talking about is going to be much better understood in the financial model, and also you'll be able to use this financial model to value your own startup. Okay, so this is the financial model. This is what we talked about last class. We did our top-down and bottom-up revenue forecast. This is top-down. This is bottom-up. This is what I talked about today. So estimating our costs. This is where in our model we estimate our manpower cost. This is our cash flow budget. So this helps us to understand on a monthly basis how are our cash flows. And these are our very detailed expense inputs. So you can input monthly again for the first 2 years, and then annually all the expenses that you can think of for your company. And this is where we start to see the financials, pro forma financial statements that I was talking about today. This is where we start to see them forming up. So you can see that based on the inputs that we made so far, we now have a balance sheet with assets and liabilities and equity. and we have an income statement, and here's our revenue forecast. This was the top-down, bottom-up revenue forecast that we worked on in the last class. We have our cost of goods sold. We get to our gross profit. Then we have the operating expense. So these are all the operating expenses that we input into the expense portion of the model. And we subtract our operating expenses to get to our operating income. And then we subtract out a few more expenses to get to our net income. And you can see net income is at the bottom here. This is called the net income line in your financial model is called the bottom line. That's why you hear people talk about give me the bottom line. The bottom line is the net income or net profit for your company. So once we have, if you think about what did we do? So we did the revenue forecast, we did expense forecast, we subtracted expenses, we got our net income. This is, by the way, this is where we calculate our customer lifetime value and customer acquisition cost. So this is called unit economics, which I also talked about today. So you can see that all of the calculations that we do in all the calculations that I talked about in both classes, we can do in our financial model. And on the next tab, we have comparables. So when I talked about comparables in the lecture portion, this is our comparables sheet. So we have here, we've given you already a basket of comparable companies, but you need to adjust this for your company. These are different sectors that might be useful comparables to you. So here we have S&P 500, software companies, pharma companies, media, retailer, support services. So you can update this data. We have the source where we got the comparable data. And this sheet lets you have very detailed comparables that we can use to check the reasonableness of the output that we're getting from our assumptions. And then this brings us to our financial page. So this is where we see the now nicely formatted income statement, balance sheet, and at the bottom here, projected free cash flows. So projected free cash flows are what we need to get to do our DCF valuation. Once again, you can see we started out with our revenue, and in this case called sales, and we got our net income, and the net income feeds into our cash flow statement. After we adjust the net income, we get our free cash flows. And in this case, the company has some negative free cash flows in the first 3 years, and then positive free cash flows in years 4 and 5. So now the stage is set for our discounted cash flow valuation. So you can see how the discounted cash flow valuation works at the bottom. We take the present value, so meaning reducing the value of the future cash flows by our discount rate. And this gives us the present value of the first 5 years of cash flows. Then we calculate the terminal value, which means this is the discounted present value of all the cash flows after year 5. So we can think of it as the cash flows from years 5 to n being infinite. We add these two numbers together, and this gives us our discounted cash flow valuation. So that's basically how discounted cash flow valuation looks in our model. And I talked about discount rate. So you can see here, discount rate that we're using is 80%. And my view is the appropriate discount rate to use for early stage startup companies is 80%, somewhere between 80 and 120%. In this case, we used 80%. Now, I mentioned that when we use discounted cash flow valuation method, the two determining factors are the revenue forecast and the discount rate. And I mentioned that we can get almost any result that we want from discounted cash flow valuation by adjusting the discount rate. So let's look at an example of that. My current valuation is 1.4 million. So 1.4 million, and my discount rate is 80%. So I'm going to adjust, I'll leave everything else the same. So we won't change any of the revenue or cost assumptions. We'll leave the cash flows exactly the same. All we're going to do is change the discount rate. So I'm going to move the discount rate from 80 to 30%. And what do you think is going to happen when I do that? When I do that, the valuation should go up because lower discount rates mean higher current valuation. The way you can think about that is, remember, we're discounting cash flows because money in the future is worth less than money today. Imagine if discount rate was 0, that would mean that money in the future would be valued exactly the same as money today. So if we made discount rate 100%, money in the future is worth much less than money today. So let's go from 80 to 30. Remember, the current valuation is 1.4 million. When I change the discount rate to 30%, my valuation just went to 14.8 million, so 10 times increase. And this is not I didn't just randomly choose this adjustment. Because why? Because I think 80 to 120% is the right discount rate, but I've had entrepreneurs in more than I like to remember, a number of entrepreneurs in Thailand give me discounted cash flow valuations for their seed stage startup companies using even 20% discount rate. So let's look at 20%. 20% discount rate gives me a value of $30 million for my company. The real value is what? The real value is 80%. So 80% gives me 1.4 million. So imagine just by changing one number in the model, leaving everything else the same, just adjust the discount rate and you can change the valuation from 1.4 million to 30 million. And what that should tell you is if you're going to be using discounted cash flow valuation, you must use the appropriate discount rate. And if you use the inappropriate discount rate, A, you're going to get a very bad result, and B, you make it very easy for the investor to negotiate against you. For example, when I get a model like this from a startup founder, and they come in with a 30 million valuation and then a 20%, and the proof of that is 20% discount rate in their DCF valuation, then I just say, why don't we change it to the appropriate discount rate, which is say 80%, and now their valuation goes to 1.4 million. Now, how do I know that this valuation is more reasonable? Because remember, when we talked about comparables by stage, I said that for seed stage companies in our market, valuation should be between 1 and 5 million. And we can see that when at discount rates like 30%, we're nowhere near 1 to 5 million. At discount rate like 80%, we're right in the mid, we're right at the lower end of between 1 and 5 million. And this is, again, just like we did with top-down and bottom-up revenue forecast. When we do valuation, it's much better not to use only one method on its own. It's much better to use multiple methods. So what I'm doing now is I'm using two methods. I'm using discounted cash flow valuation and I'm using comparables method. And if my discounted cash flow valuation is reasonable, it should agree with my comparables method. And when we do VC method, we're going to have an even third check. So we're going to make sure that our VC method agrees with our DCF method, which agrees with our comparables method. If you do your valuation this way, you're going to be a very tough negotiator against a venture capital investor. If you do your valuation this way, you walk in with a 30% DCF valuation, you're going to be immediately destroyed by your venture capital negotiator. I mean, you're going to have no leg to stand on with that type of analysis. So if you believe your company really is worth 14 million, then you need to show with 80% discount rate that you're still worth 40 million. If you can do that, 14 million. If you can do that, okay. I mean, I'm still going to argue that it's outside the comparable range, but at least you won't immediately be in a huge hole because you use the wrong discount rate. Now.
Okay, before we go on to the Q&A box, here are some of the submitted questions from the survey last time. I think you have talked about the first and the second questions briefly. How do we get the assumptions, sources of information for both top-down and bottom-up estimates, as well as the fact that financial projection is one of the main challenge for entrepreneurs, since several entrepreneurs may not be familiar with financial statements. Would you please sort of give a quick comments on these 3 points and then go on to the very last questions?
Okay, so how to get the assumption. I mean, this is the most of the work that you're going to be doing on your financial model. I would estimate that for you to put together a really good financial model for your company is going to take about 200 hours. So it's not something that you're going to do over the weekend. And this is not building the model. I mean, let's say between 100 and 200 hours to really do the work that you need to do to make a realistic and reasonable financial model. It's going to be worth it in the end because this is going to be something you're going to use for the lifetime of the company. You're going to update many times, but you need to start thinking about this. So how do we get the assumption? It's based on your understanding of your market and your business. So basically you have your strategy. You know what's your target market. Then you check secondary market research to see what's the total addressable size of that market. Then you have to make some assumption about in your strategy where are you going to focus within that market. So basically the assumptions come from your strategy. First you develop your strategy, and then you try to quantify your strategy in your assumptions in the model. That's for top down. Bottom up comes from your business model strategy. So business model, like let's say your bottom up estimates. So bottom up estimates look like, basically it comes down to how many product are we going to sell in month 1, month 2, month 3, month 4, and at what price. So what's the source of information for that? Your pricing strategy and your sales strategy. So how many customers are your salespeople going to be, or you going to be selling to every month, and what percentage of those you're going to be able to convert, and then how much you're going to make on each of those sales. So all of these assumptions come from your strategy for your company, and the sources of that information for top down, they're generally secondary sources like research analysts, industry analysts. For bottom up, it's primary. So it's what you know about your products and your customers. Okay, financial projection is one of the main challenges. Entrepreneurs are not familiar with financial statements. Yeah, it's a real challenge, I know. It's not fun. It may be, I think entrepreneurs hate having to do the financial projections, hate working with the financial model. I get it. I also, when I first got into financial modeling, I didn't love it either. I think it's something you want to get comfortable with, because if you want to build a successful startup, you need to be comfortable with your financial model. So have to do some basic training and then play with the model. I think the best way to get familiar with financial model is start to play with it. And this is why I gave everybody a copy of the model. We don't usually give this model away to so many people because it's, you can see a lot of work went into this model. But I want to share with everybody here so it gives you a chance to improve your financial modeling skills. The good thing is, if you don't start with a model template like this, you have to build your own model. That can also take a really long time. So good news is you don't have to do any of that. All you have to do is do input and then see the output. So it's a lot of the work is already done for you. Now, there are many other financial model templates. If for whatever reason you prefer one of those, great, use those templates. But I would say the best way to learn and improve your comfort and capabilities with financial projection is practice. So just start putting assumptions into your model, play around with it, and then try to understand how it's working, do the best you can, and after a while, you're going to get much more comfortable. On making adjustment between top down and bottom up, determine the range or number is appropriate. This is where we use these two to keep each other in line. So bottom up, we should be pretty comfortable with, and top down, therefore, gives us a control on our bottom up. So if we always watch both at the same time, we shouldn't wind up with a really bad answer for either one. Okay, so moving to our current, and then this was another question from last week. So it was an interesting question about rights issues, rights offering. So I think I think the question here is mostly should we use rights offering to raise money? This is generally not advisable for companies that are trying to raise money to get to an IPO or trade sale, because in a rights offering, typically we sell shares at a discount to existing shareholders. This is A, potentially dilutive, and B, it reduces share price. What we want to be doing as a successful startup is always raising the next round valuation at a higher price than the last round. And we also typically want to bring in new investors, because new investors will generally give us a better price than existing investors. So, and also a more market-centric price. And of course, this terminates with this culminates in the IPO or trade sale where the market really prices us. So I would say in most of the cases that I saw, companies use rights offering when they're struggling, they can't get outside funding. So I would generally not advise rights offering as a strategy for a startup that's trying to get to a big trade sale or IPO. I would focus on raising new rounds of equity funding and getting to the exit. Okay, so now I'm going to go questions in the chat box. The first question says, if terminal value is the value at year 5. So terminal value is, just to correct that, terminal value is not the value at year 5. Terminal value is the value in this model. Terminal value is the value of all future cash flows after year 5. So from year 6 to end, because when we're discounting cash flows in the model, we only discount explicitly, we only discount years 1 to 5. That doesn't value the company. That values only the first 5 years. So the real value of the company is the value of the cash flows that are discounted in years 1 to 5, plus the discounted values of all future cash flows. So the terminal value is the discounted value of all future cash flows. There's a different terminal value in years 2 and 3, because in year 2 and 3, we're providing a value as if you're looking at the company from year 1. So this is a valuation for the next round investor. So it assumes that in year what says year 2 in the model, it assumes an investor that's coming in year 2. So year 2 would be year 1 for that investor. And therefore, the terminal value will be different also for that investor in year 2 and in year 3, because the company is now projecting forward from year 2 or year 3. Year 1 and 2 would become historical in that case. Next question was about how to submit the assignment. So you can submit the assignment in the companion online course. So companion online course, you go to assignment page, it's going to give you an upload feature. If that's not working, contact me or Nan, and we'll help you to submit the assignment in email. So how can we, next question, how can we evaluate, which I think means value platform business? Most of them are running losses at least in the next 3 to 5 years. Most of their business model have been changed very fast. Cost of customer is not the price that they paid, but the switching cost from company's platform. Users of Apple, Amazon, or Meituan, WeChat cannot live work smoothly without using these services. So yeah, it's a really good question. What if the company has negative cash flow for the entire forecast period? Then definitely we can't use discounted cash flow. We will then use VC method. So VC method is going to be in the next class. In the first class next week, I'm going to go in detail explaining about how VC method evaluation works. And VC method evaluation will work for companies with no cash flows or negative cash flows. In the case where the company never has positive cash flows during the forecast period, this can happen not just platform companies, but for example, drug development startup. And we won't be able to use DCF in that case, so we'll use VC method, which I'm going to talk about in detail in next class. So interested in that, then don't miss the next class. There's also in the online course, lots of information about VC method. Next question was about, can I get the video for this and previous class? Yes, you can definitely get both of the Zooms are recorded, and just contact me or Nan, and then we'll send you the link to the video. Okay. The rest of the questions. So the rest of the questions more about logistics, but the last question, can we use Excel template for all types of business, including FinTech? Yes, you can definitely use the Excel template. Is designed to be used for all types of startup companies. It is weighted towards startup companies. So, for example, the most important example, it only allows equity financing because most startup companies are 100% equity financed. You can't do debt financing in our model. So for larger, more well-established or public companies that are doing a mix of debt and equity funding, there'll be a challenge using the model. But for all startup, no matter what your sector, you can use the model. And we use the model to evaluate startups in many different sectors, including FinTech. Okay, so now now I'm moving into the Q&A. So the first question is so semi-variable example. Can you give examples of semi-variable costs? Semi-variable costs would be example like something like that is not variable in the same way in every period. So a cost that has both a fixed cost component and a variable cost component. Like for example, let's say your telephone bill. So maybe you have a basic charge in your telephone bill every month, and then you have variable charge based on like number of SMS you send or data that you use. So this would be a semi-variable cost. So next question was, and there's lots of other examples there, happy to discuss that if you want more. In the online course, there is a conversation function. So if your question is not answered here, or if you want to chat more about any of the questions that I'm talking about, or have answers to other questions, just feel free to put the questions into the conversation feature in the online course. Why is the cost of capital between 80 and 100% in seed stage? So this is a really good question and super important question. I'll give the quick answer now, and then I'm going to go into this in a lot more detail in next week's class when we talk about VC method. But 80 to 120% is seed stage because the appropriate discount rate for DCF valuation. So what should be the discount rate? The discount rate for DCF valuation should be the company's cost of capital, the company's weighted average cost of capital. And normally weighted average cost of capital is the company's cost of equity times the percentage of funding they have in equity, and weighted together with the company's cost of debt and the percentage of the company's funding that comes in debt. So that's called weighted average cost of capital. I already mentioned when I was talking about our model that our model assumes 100% equity for financing. So in our model, the company's cost of capital is equal to their cost of equity. And the annualized cost of equity for a seed stage company is 80 to 100%, 120%. And next week, I'll explain in more detail how I did that calculation, but that's the short answer. The short answer is that this reflects the cost of the company's cost of capital from equity investors in the company at that stage. Okay, next question was, if there's a shareholder who wants to sell his or her shares and leave the company, which valuation should we base on? Current valuation or forecast value or forecast valuation? So this is in real life, this is going to be subject of negotiation, because if you're a shareholder and you're trying to sell shares to another shareholder, then that valuation is going to have to be determined by a negotiation between those two shareholders. Of course, if I'm the selling shareholder, I'm going to want to sell at the share price that the company is trying to raise money from investors at. If I'm a buying shareholder, then I want to sell at last round price or whatever the lowest possible price is. So I wouldn't say there's a answer like which valuation should it be based on. I think that in real life, the valuation is going to be determined by negotiation between the buying and selling shareholders, where the selling shareholder is going to argue for a higher price and buying shareholder is going to argue for a lower price. In selling shareholders in this type of situation generally don't have a lot of leverage because there's usually a pretty thin secondary market for these shares, meaning there aren't that many buyers. So if you're really motivated to sell and you don't have very many buyers, then you're probably going to sell at a lower price, which means you're probably going to get something like the, best case, you're going to get the last round price. And I actually have seen a lot of negotiations like this, and happy to talk about that in more detail. So next question. The question about where does the NPV formula come from? How to calculate it? Usually I use NPV, discount rate, cash flow. So the NPV formula in the pro forma model, it's basically standard net present value formula, but you probably noticed that it has adjustment factor at the end. And what that adjustment factor does is it calculates your cash flow as if they occur in the middle of each year rather than at the end of the year. The standard NPV formula that you're talking about here, it models the cash flows as if they occur once a year at the end of the year. And in real life, cash flows are spread out over the year, but we don't have any formula that really calculates cash flows spread out over the year. So the adjustment factor that I use in the NPV formula tries to essentially shift the cash flows into the middle of the year rather than the end of the year. Okay. But if you're not comfortable with that formula, you can adjust it to use your own, your basic NPV formula, and the results will still be valid. Okay, 80% cost of capital implies year 5 cash flows are worth just 5.3% of year 1. This means only very high revenue potential companies will have sufficient present value that is greater than necessary growth capital need to be raised. It's very, very high hurdle. Very few companies will look good under an 80% rate of return. Perhaps that's the point. This is 100% exactly the point. And I'm Michael, thank you very much. I'm really glad that you brought that up because, and I can tell you 80%, it's already a little low. In real life, it's going to be 100 to 120. And next week, when I talk about VC method, you're going to see why this is 100% driven by venture capital economics. And it is exactly the case. The vast majority of companies in the world should not be raising money from venture capital investors, exactly because what you say here. Venture capital investors have extremely high hurdle rates to meet, and therefore their capital is reserved for companies that can exceed very high hurdle rates. So I have a whole article on this. It's called Good Company versus Good VC Investment. The vast majority of good companies are not good VC investments. So if your company isn't, like, let's say no matter, and actually this can be another very, very valuable outcome for your startup company is when you start putting your financial forecast into a model like this and you realize at 80% discount rate at a realistic, any realistic forecast that I do for my company, when I apply 80% discount rate to the cash flows, my company's worth nothing. And so what do I learn from that? I learn it doesn't mean it's not a good company or a great company. It means it's not a good VC investment. So I shouldn't be raising venture capital. There are many other ways to fund the growth of your company besides venture capital investment. So that's why this can be, a very valuable exercise. That's why it's so important to have a financial model for your company, because if you don't, you won't know what is the right means of financing your growth. Okay, next question was, please show how to get answer from which page of Excel. If this is about the exercise, exercise 1, it's all the first pages. Exercise 2 and 3, there are different pages in the Excel, but they're keyed in the exercise. So pay close attention to the instructions in the exercise, and it'll tell you which page of the Excel to work on. Okay, next question was how to do valuation for second round and upper. So for the model lets us, using the same set of assumptions, the model lets us get a second round and third round valuation. For rounds beyond that, we're going to have to estimate valuation. So the purpose of providing multiple rounds in the model is basically to help you calculate the dilution that the company is going to experience. So it's not as rigorous as year 1 valuation because we have fewer periods to discount, but you can definitely use it to calculate the dilution at least. Okay, next question was, what does times earning mean? Okay, time earnings mean this is a way to estimate when we get to estimating exit valuation. So there's typically two ways that companies are valued at exit. One way is multiple of revenue, and another way is multiple of earning. If we value the company at multiple of earnings, that's also called times earning because time means multiple. So time earning is a way of valuing companies as a multiple of their earnings. I just skimmed through Bad Blood. How is this book has anything to do with our study? Oh, so Bad Blood is a book about Theranos, which was a startup that raised a lot of money and turned out to have a product that didn't really work. So this doesn't necessarily have much to do with valuation in our class, but this is in my reading list of books for entrepreneurs and investors because I think it's a very interesting example of a startup that raised a lot of money without having strong fundamentals. And I think it's a cautionary tale for both investors and entrepreneurs about what can go wrong with companies raising a lot of money.